Okay, class, we're in chapter 16. A little explanation before we start. This is part 2. When I first did part 2, unfortunately it was too big, and when I went to download it, I couldn't do it. So I'm going to have to break part 2 into two parts, part 2A and part 2B. I had to do that because part 3 and 4 are okay, and I already downloaded those, and I didn't want to have to do those over. So we're doing part 2 and part 3 of chapter 16. And we pick up with slide 10. Here we go. The formation and operation of a sole proprietorship. So with the sole proprietorship, nothing has to be done with regard to its creation. The person who opens the business is the business, so to speak. At most, they have to file a certificate of an assumed name, trade name, or fictitious name. So if it's Bob Jones and he's doing business as Acme Plumbing, he has to file with the Superior Court clerk's office in the county where he's doing business a certificate of assumed or fictitious name. In other states it works a little bit differently. Usually it's done with the Secretary of State. You have to apply for a tax identification number, also known as an EIN. If you're going to be selling goods that are subject to sales tax, you have to get a sales tax permit from the tax commissioner of the state of Georgia, and you have to collect tax and turn it in on a quarterly basis. You may have to get a license. There are two types of licenses that may be required. One is a general business license, which is for tax purposes only. You just pay a fee and you get the license. The other is a professional or trade license. That's the type that requires you to have some education or training and to take some test and pass it in order to be licensed. So lawyers have to do that. They have to be licensed by the state through the bar, and you pay a fee for that. You have to go to law school. You have to pass the bar exam. A cosmetologist does the same thing. They have to go to school, then they have to pass a test, and they have to have a special license for that. If you're going to be dealing with any intellectual property, you need to register your trademark, copyrights, and patents. So we talked about all that. Now, with a sole proprietorship, you do not pay you pay your taxes just like an ordinary person. So on your 1040 form, your long form, at the bottom there's a space for business income, and it says see Schedule C. Schedule C is a separate page that you complete, which shows your income from your business, your legitimate expenses that are deductions, your net income from your business, and then you carry that back over to your 1040 form. Okay, so this is your application for your employer identification number, which you get through the Social Security Administration. You can do this online. You can complete it online, and you will get back your number actually within a very short period of time, I think within a few hours. This is just a Social Security type number for a business. Okay, so partnerships is another form of business. A partnership arises when two or more people enter into a business for profit. Okay, the partners are the co-owners of the business, and they have joint control over management of the business and the right to share in profits. The partners to a partnership can be individuals like sole proprietors, or they can be some other form of business, a corporation, an LLC, etc. So partnerships are governed by the common law and by statutory law, and primarily it's state law. Because we have 50 states, again, it's a good idea, like in so many other areas, to have a uniform law. So the Uniform Partnership Act was adopted many years ago, and then it was revised several years ago into the revised Uniform Partnership Act. Many states have adopted one or the other. Georgia still goes by the old one with some changes to it. So you have to check the statutory law of your state, though most of it is pretty consistent from state to state. We talked about agency law with regard to in general, and how it applies to partnerships is that each partner is an agent of the other, and therefore there's the fiduciary duty, and therefore there's also the potential for vicarious liability in that situation. Okay. The requirements, you need an agreement, but there are situations where you don't have to have an agreement. The agreement can be in writing or it can be oral. It can be express or it can be implied. And it can also be determined to exist as a result of conduct by a court making such a decision. So in a partnership, each partner usually agrees to commit funds, and you're responsible for liabilities of the partnership. You can also agree to commit assets, labor, and skills to the business. We talked about the Uniform Partnership Act, and so as far as capitalization of a partnership, usually each partner contributes something in the way of capital, whether it be cash, property, skills, work, etc., or a combination of them. So one of the essential elements is that the partners share in profits and losses. Goodwill, as you know or should know, is the value in a business of its reputation. And there is a value in many businesses of having a good reputation, and that can be converted into a actual cash value when selling a business. Okay, gap filling. So the law says that a partnership can do almost anything it wants to do if it puts it in its agreement. But where it's not in the agreement, then the statute or statutes are going to fill those gaps. And here is a list of some of the gap filling provisions. So let me take one as an example. All partners have equal management rights. Okay, now you can agree in the partnership agreement that only one partner is going to be the manager and the other one is not going to take part in it. But if you don't say so in the agreement, then the gap filling fills the gap. So another example would be profits. Okay, suppose you have 3 partners and they want to share their profits equally. They need to put in their agreement that they're going to share their profits equally, 1/3 each. If they fail to do so, the gap filling would say the same thing, 1/3 each. So let me change that scenario because that wasn't really good. But let's say that partner A is going to be 50% owner and the other 2 partners are going to be 25%. They have to put that in the agreement. If they don't, then the gap filling is going to put it at 1/3, 1/3, and 1/3. Okay, so you can look at the rest of those. Okay, for tax purposes, a partnership is what we call pass-through taxation, and that means that the partnership passes the profits on to the partners, and the partners put that in their 1040 on a line on the front page of the 1040 as income. And you're taxed as an individual. The partnership itself does not pay any taxes. However, the partnership has to file an information return with the IRS saying who they've given money to, who they've shared the profits with, so that the IRS can follow the money and make sure that people are paying their taxes. Okay. Formation and operation. You can have your agreement, which is called the Articles of Partnership, or any other title you really want to give it. Again, it can be oral, written, or implied by the conduct of the parties. You should designate the duration, or else the gap filling is going to do it for you. A partnership for a term is called a fixed duration. A partnership at will has an indefinite duration. Now, you can have a situation where a third party conducts themselves or interacts with the partnership and reasonably believes that there is a partnership, and that was what was represented to them, even though there wasn't any. In that situation, the partnership will be stopped, and that means that the court will say that there actually is a partnership for legal purposes because of the conduct towards the third party. The rights of the partners relate to management, interest in the partnership, compensation, inspection of books, accounting, and property. So I'm going to stop there with Chapter 16, Part 2A, and we'll then go on to Part 2B. The magic word is franchise for this chapter.